Welcome back to the Long Put Masterclass. My name is Stephen Cox and I'm a full-time options and futures trader, and I'm also the CEO of Share Navigator. So just as a reminder, this is the final episode in a 6-episode series on the Long Put strategy. We've used NVDA as an example, and we've covered what our profit and loss would be, what our break-even price would be, and what our maximum risk would be. We've also benchmarked the long put strategy versus shorting a stock and showed you why it's more capital efficient to use the long put strategy. And we've also looked at all of the Greeks: delta, theta, gamma, and vega. Today, we're going to put all of that theory into practice, and we're going to show you how you would actually go about placing a trade and how would you use the profit and loss tables on an online brokerage platform. And finally, we're going to give you some guidelines as what to look out for when you actually go to buy put options and indeed call options. Okay, so let's look at and discuss placing a trade. So what you're looking at here is an option quote screen on a typical online brokerage platform. And we're looking at an expiry date here of about 80 days out. So normally on a quote screen, you're going to see call options on the left and put options on the right, with the middle column separating them, which is the strike price. So we're going out about 80 days. Some of our guidelines, we want to have our expiry greater than 60 days. And the reason for that is, remember the theta decay. We don't want theta working against us. Secondly, we want to pick a strike price that has a delta of about 0.7. Now, deltas for put options are negative, so it'll be negative 0.7 we're looking at. So you can see that brings us to the $218 strike, where the delta is minus 0.694. And also we're looking for something that has a narrow bid-ask spread. And the reason for that is very important. Don't forget, when you buy something at a certain price, you only get to sell it at the lower price, which is the bid price. So if the spread is too wide, you're already at a loss before you've even got started. So you want the spread to be narrow. We're going to show you how to haggle with the market for the price in just a moment. So in order to get the order started, all we've got to do is click on the ask price, where you can see it there. We've highlighted it. It's 30.55. Now we're going to haggle with the market, and we're going to show you how to do that in the following slides. And this is an example of what the order window will look like. So let us talk you through each section in this order window. So in the top half of the order window, you can see that it's a description of the trade, just making sure buy 1 January 16th, $218 put option. It tells you what the break-even price is going to be. And on the right-hand side, you'll see a blue order button. We're not ready to click that yet. Then you're going to see the ask, the bid, and then the mid price. And we're going to talk about haggling with the market now in a moment. And then finally, in that top section, you'll see a reminder of what the order is. In the middle of the order window, you get the performance profile of the trade. So it's telling you, it's calculated your max loss for you. It's calculated your break even and your max return. So you can see the max return there is $18,517. That will be on the assumption NVIDIA went to zero, which is very, very unlikely. But it just gives you your max return for a particular option trade. So you know exactly what your trade has to do right here in front of you. And also an important piece of information there is the probability of profit, which is 42%. So remember, we discussed the downside of buying a put option is this theta value, or the time value that's decaying every day. And that's why your probability of profit is lower than 50%. It's because of the fact that an option is a time wasting asset. So you really do need it to move in order for you to make money on the option. Another reason the probability is lower, it's because your break-even price is lower. Remember, you want the share price to fall, and the share price when we placed this trade was at 193.02. This has to fall down to a break-even of 187.08. So the share price has to fall a bit just to break even at expiry. So that's why your probability of profit is below 50%. And at the bottom of the order window, you're going to see your profit and loss table. So it automatically defaults to the expiry date, which is what we're looking at now. And we've changed it to a 10% move in the underlying share price. So you can see here, the range of potential outcomes is anywhere from the share price falling up to 10% to rallying up to 10%. And what would that mean for us in terms of profit and loss? So you can see there that if NVIDIA fell only 1%, we would actually lose $367 on this trade. If it went down 5% at expiry, we would make $404. But look what happens when we change the last trade date to something closer to where we are now for the exact same moves. You're going to see different results. And this is where we told you that the system automatically works out your delta, your gamma, and all those Greeks for you. So we've changed the last trade date in these profit and loss tables for the same 10% move. And you can see there now, if the share price of NVIDIA dropped 5%, we would actually make more. We'd make $594. And it's the same for a 1% drop. You can see we'd actually lose a marginal amount there. The reason for this is we've still got lots of time value. Remember, the expiration on the put option is not until January. We're looking at the potential outcomes on November the 16th. So that's the brilliant thing about these online brokerage platforms. You get to figure out, and it does all the delta, the theta, the Greek calculations for you, and will tell you, give you an estimate of what your profit or loss will be in a certain date if the share price went up or down by a certain amount. So now that we're happy to go ahead and place the trade, we're just going to click on the blue button on the top right hand corner of our order window. So this is the order window that you're going to see, and we're going to talk you through each section now. So the top half of that main order window again just tells you what the option is. It describes it. It tells you the last price, and it gives you the bid ask price, the current bid ask price. And then it just reminds you that you're going to buy this option. In the middle section, we're going to enter the trade parameters. So this is what you're going to see as a default. So you can see it's telling you, are we going to buy or we're selling? We're buying the put option. The quantity default is automatically 1. And then the order type, they have a default of limit. And limit is where you dictate the price to the market, what you're prepared to pay. So this is where we spoke about haggling with the market. There is another type of called a market order, and that just gets you filled the next available price. We wouldn't recommend that when you're trading options, especially in the first hour of trading, because the bid-ask spreads can be wide. We would rather that you choose a limit price. So you can see there, we've entered $30.40 into the limit price box. The next window is how long is this order going to be in place? And we have good till cancel. That means the order will stay in the system until it's filled or until 6 months, whichever comes first. Then we can decide that we can go for one more preview of the order before we decide to actually press the buy button. So you can see what the preview looks like. Again, it's just reminding you what your trade is so you can make certain you're placing the right trade, what your limit price and all the parameters that you've just entered will be on that preview window. And then when you click on submit buy order, it goes into the system. And you can see here, we've got a message straight away saying that we've been filled at $30.40. That's why we always say you should haggle with the market. Don't just take the ask price or put in the market price. So this is what a typical long put option would look like. It's telling you the description of the trade, the position is 1, and it's telling us how much profit we've made since we've placed the trade. So here are some trade management guidelines for buying a put option. First of all, before you even set up the trade, make sure you pick an expiry that's at least 60 days to expiration, and that you have a delta of circa minus 0.7. The reason for that is we want to avoid that theta decay we spoke about in our previous episode, and we want to give ourselves the best chance of actually making some sort of a profit in this trade. Then if the trade does become profitable, make sure you sell out at about 50 to 75% of your profit. So in our situation with NVIDIA, we want to be selling out if the value of the put option reaches $45. But what happens if the NVIDIA doesn't move quick enough or just moves very slowly? If we're still bearish on the trade, we can roll out, which involves selling our existing put option and then buying another one for a later expiry to avoid that theta trap we spoke about. And then if you've changed your mind and you're no longer bearish on the stock and you think it's actually going to rise, just close the put option and take your loss. And always remember asset allocation. Remember, you can lose all of your investment. So even though you think you might have the direction right, you're up against the clock and it has to move within your time frame. So please don't put all your eggs in one basket and allocate wisely. So that's it for the Long Put Masterclass. If you liked the content and you want us to provide more option content and other option trading strategies, please like and subscribe to our channel. And remember our mentoring service. Start with a free trial, work one-to-one. It's simply the fastest way to learn how to trade options and futures.